Good morning, everybody. Eric, you joining us from
Morning.
California, direct from California. It's Eric. Thank you, Eric. Thanks for joining us. How's the weather by you in Malibu?
It's 65, will be 70, same
Oh,
as
okay.
always.
Did you go for your morning run or not yet?
No, I'll probably get that in later.
Okay, good. All right. Well, everybody, thanks for joining us. Eric, I see you're wearing a black shirt. I was always wondering whether we should just get kind of standard uniforms for these presentations. And I was thinking black because Steve Jobs always wore black, and Elon Musk apparently always wears black. So maybe that's the way to be a successful entrepreneur. The only problem with that is Elizabeth Holmes also wore black. She wore these turtlenecks to because she thought it worked for Steve Jobs. So it can also work against you, I suppose. But meanwhile, I should say that Max is here. Max is a little tired. We had a big birthday bash for the second year birthday of the bull market. We had a good time. I hope you're all having a good time. October 12th, 2022 was the beginning of this bull market, and it's still going strong. Eric, it's feeling a little bit, just a little bit, kind of like a melt up to me. You getting a little bit of that sense?
Yeah, definitely. I mean, I'm glad we raised our odds, but the Fed has done no favors to the bears, I suppose.
Yeah, no, it's and we don't really have a problem with a melt up. I mean, you can make a lot of money. The only problem is we're going to have to figure out when to tell people to get out at the top. That's always the tricky thing in these things. But who knows? Doesn't have to be a melt up from here. The valuation multiples are stretched, as stretched as they were back in the melt up of the late 1990s when the Buffett ratio, I think, got to 2.8, was it, Eric? Do you recall? Something like that, all-time record high. And then, fortunately, the PE is still not that bad. It's 22, I guess, on the forward PE of the S&P 500, and that's with only seven stocks being somewhat extended, and that's the Magnificent Seven at a forward PE of about 30. You take them out, and you got something that's a little bit more affordable at 19. But again, they're not giving away stocks here, and we're kind of counting on earnings to be doing pretty well. You want to give us a kind of a quick wrap up of what you wrote for the quick takes on the third quarter numbers, what the analysts are looking for?
Yeah, I mean, something we've been talking about a lot is how negative the Citigroup Economic Surprise Index got last quarter. As we all know, that's turned positive recently, and the 10-year yield has, risen alongside it. But analyst expectations got really downbeat as well. That's the kind of earnings hook that we talk about. They fell from up near double digits to now just expecting 3.5% year over year growth in earnings. In the third
S&P
quarter.
500 earnings, yeah.
Yeah,
S&P,
and for the S&P 500.
yeah.
But that I think that sets up for a very large earnings hook. We're expecting at least double that. And just like everyone got too bearish on the economy, we think analysts got a little too bearish as earnings surprises were
Right.
negative a few months ago. So it's a good setup. It's a low bar to clear. We'll see how companies do versus the whisper numbers, but I think it looks pretty good.
Yeah, and they did that also in the first quarter and the second quarter. We had upward revisions in I think it was almost a doubling of the growth rates in both of those. So the analysts definitely have been somewhat pessimistic, but as we've observed over the years, they have this tendency to lower their numbers going into the earnings season, and then surprise, surprise, it turns out to be better. I think it's partly because the companies that are clunkers kind of get the word out that they're don't expect us to do as well as you thought. Uh, they don't want their stock to take a dive the day of their conference call, so they kind of feed the analysts some lowered expectations. On the other hand, the companies that are about to report some really good surprises like to keep it quiet until the reports actually come out. And when they do, the market says, "Oh, that's a lot better than we thought," and analysts say it's a lot better, and they revise the numbers up, and the stock goes up quite a bit. So it's kind of a game, but it's it's a fairly predictable game, and it certainly works when the economy is growing. When the economy is in a recession, obviously, analysts are scrambling to lower their numbers, and companies are scrambling to lower their guidance. But for the past 2.5 years, we've been in the no landing camp, and basically viewed analysts' expectations as being fairly predictably pessimistic going to earnings seasons, and then turning out to be better than expected. Meanwhile, if we look at forward earnings, which is a time-weighted average of analyst expectations for this year and next year, obviously we're giving more and more weight to next year's analyst expectations. Obviously, in that situation, forward earnings have actually been going up. So you can have a situation where analysts are lowering their number for a quarter, but the forward earnings currently is rising into record high territory, and that's been a very important support to the market. That's the fundamental support to the market. The air in the market is the valuation multiple, and the valuation multiple is stretched. And maybe as interest rates come down here, maybe not too quickly if the Fed takes our advice, the valuation multiple maybe has some more upside. But as we said, it's they're not giving anything away here. Eric and I have had a conversation this morning and discussing what the Fed's doing. As you probably know, we've been thinking that the Fed's getting ahead of the curve here in terms of lowering interest rates, and that they've pivoted too dovish from their hawkish stance. But we've also admitted many times that our job is not to tell the Fed what to do, but to anticipate what they will do. And it certainly looks, Eric, as though they still want to do a quarter in November and a quarter in December. We'll see how they kind of line things up as we get closer. But there'll be more data coming out. The data that's come out so far, Eric. How many Fed officials have talking heads have said anything about maybe holding off in November?
Yeah, I know Bostitch did. It seemed like Lori Logan, who's not a voter yet, is leaning that way. But we'll see. Who knows how if the labor market data kind of stays a little downbeat due to the weather as well as the strikes, they might just use that as an excuse to kind of stay dovish. You know what I mean?
Yeah. So they could do a quarter.
Yeah.
Yeah, 50 doesn't look like it's very likely given that you're also doing some work on the stickiness of inflation. We find ourselves in a strange position where for the past, really since the summer of 2022, we've been arguing that inflation is going to come down and come down fairly predictably, with durable goods inflation coming down, with the non-durable goods inflation coming down, and services kind of lagging behind that. And we did think we could get to 3 to 4% last year. We did again in the summer of 2022. So that was pretty much not a consensus view. A lot of people thought it could take a long time and it would require a recession. And then last year we started to talk about 2% this year. So we're getting pretty close there. But now we're kind of pivoting ourselves in terms of our research and saying, well, wait, there's still some stickiness in some areas of the economy, like the super core inflation. What are you seeing there, Eric? And what is it?
Yeah, so super core was a hot topic for the Fed a couple years ago. It's like, it strips out a lot of things from inflation, but it's basically core services, and then you strip out shelter as well from the CPI or from the Fed's preferred PCED. And about 2 years ago, Powell said, this is the most important measure of underlying inflation. It's very tied to wages. It gets rid of the volatile components. And it's come down, but it's still very high. It's around 4.5%, or it ticked up from 4.3 to 4.4% in CPI in September. It's still fairly elevated in the PPI. It's a different measure in PPI, but it's still around 3.7%. So, goods have been deflating for a variety of reasons that we've highlighted. Oil prices have fallen a lot. There's been a lot of tailwinds for inflation to fall, but as long as these really sticky components of inflation remain there, you set yourself up to be to be at least above 2% more often than not, or to be more vulnerable to upside surprises and inflation. So a premature, mission accomplished by the Fed risks that demand will outstrip supply, and then we'll see stickier inflation from here.
Yeah, so we're kind of saying easy does it. If you're going to ease, do it incrementally. Don't rush it. Don't do it every single meeting. See how the data lines up, since the mission hasn't been completely accomplished. Now, Eric and I have also had a conversation. We've been writing about the fact that the bond market seems to agree with our view, in the sense that the Fed's attitude seems to be what John Williams of the New York Fed is. He's got this obsession with the neutral interest rate. And if you look at the summary of economic projections, it's the Fed's obsession. The FOMC every quarter gives us GDP, unemployment, core inflation, actual inflation in terms of where they think the median estimate shows it, where they think it's going to go. And they also have something called the long run values for these numbers, and for the Fed funds rate. They think the long run level, or neutral level, let's call it, what they really have in mind, is 2.9%. And if their inflation target is 2%, they think they're on track to get there. Then that implies that they think that the real Fed funds rate is 0.9%. Now, we've expressed the opinion that that's a fantasy number. Who makes any decision based on an overnight Fed funds rate adjusted for the year-over-year inflation rate? But more telling recently is that the bond market, again, seems to agree with our viewpoint. And what we're seeing is that the bond yield has gone up. And Eric, what's been going up? The TIPS yield, or the expected inflation, or both?
Yeah, so I mean, both to some extent, but inflation expectations, which you can look at break evens, which are nominal yields minus tips yields, or you can look at inflation swaps, have risen pretty dramatically since the Fed cut, and from pretty low levels. But I think it points to the fact that the Fed, or at least the bond market, perceives the Fed to be a bit premature, and something that we have discussed is this idea of the real Fed funds rate. It's kind of a misnomer. It doesn't really make sense to adjust an overnight rate by the year-over-year change in inflation. A lot of Fed officials, including Williams and including Austin Goolsbee at the Chicago Fed, are very concerned that as inflation falls, this real Fed funds rate gets increasingly tighter. But it's funny when you look at, and Ed was discussing this with me this morning, when you adjust the overnight Fed funds rate by long-term inflation expectations and the bond market's perception that, hey, inflation might be higher for longer, it's actually collapsed. It's much easier today than it was just a few weeks ago. It's gone from a 3.3% real rate to 2.5% in just a few weeks. So the Fed has eased financial conditions, kind of by their own measure, their own adjusted measure, very quickly and rapidly. And I think, the markets are responding to that.
So basically, we're sort of expanding our concerns here about this real rate thesis, and that not only does it, practically speaking, doesn't make a lot of sense, but okay, let's say you believe in it. Then the question is, how do you adjust the nominal rate to be the real rate? Do you do it with the actual inflation rate, or do you do it with the expected inflation rate? And then how do you measure the expected inflation rate? Do you use the University of Michigan's consumer sentiment measure of that, or do you use something that you get on a daily basis, as you just mentioned, which is the inflation rate, which is in the bond market, which is the differential between the nominal 10-year and the TIPS 10-year? And so you've got the situation where the Fed says, oh my goodness, actual inflation is coming down. We better lower nominal interest rates so that real rates don't get too restrictive. And meanwhile, if you adjust the nominal rate with expected inflation of the bond market, it's an exactly the different story, where the market is telling you that you're not going in the right direction here, that you're being too dovish, is what we're saying. Eric, let's do a quickie on the charts here. Quick look at the charts. So we celebrated the 2-year anniversary, 2-year birthday of the bull market. There's a couple of charts here that are worth reviewing quickly with you folks. And by the way, feel free to populate our Q&A. We got one, Joe so far with a question. We'll get to it in a minute, but we'll try to leave a little bit more room for some a give and take here. This is a fun chart. This shows the index of leading economic indicators. We call it the index of misleading economic indicators. It's been predicting a recession since December of 2021. It peaked over here and it's been falling and it continues to fall. Yet, interestingly, the S&P 500 happens to be one of the 10 components of the index of leading economic indicators. And for a while there, in early first half of 2022, it kind of it was not a dissenter. Let's put it that way. It agreed with the index of leading in the other indicators, but then it started dissenting over here from October 12th, 2022 to now, and it's gone to all-time record highs. And so far, you got to say the market's been spot on, at least since October 2022, figuring out that, hey, maybe we can have inflation come down without a recession. And maybe the Fed tightening here isn't going to cause a recession and isn't going to be as restrictive. And if it causes a credit problem, then we'll worry about it. But the Fed dealt with that in March of last year when there was a banking crisis in California. It didn't last very long because the Fed provided a liquidity facility. In the past, when there was a credit crisis, the Fed would respond by lowering interest rates sharply. This time around, they said, no, inflation just isn't even close to our 2% target. Let's just provide liquidity to see if that'll patch it up. And it worked like a charm. They learned how to play this whack-a-mole game in the credit markets back during the great financial crisis and again during the great virus crisis. So it worked, and that allowed the economy to continue to prove its resilience, for inflation to come down for all sorts of reasons we've discussed, without a credit crisis, a credit crunch, or a recession. And so here we are with the stock market at a record high. And we're in agreement with the stock market. We think leading indicators, it's time for a product recall. I mean, there's something defective about that index, and it's got to be recalled. That's happened before. I don't recall exactly one, but at least 20 years ago, the leading indicators was brought back into the garage, and they changed some of the indicators and said, "Hey, look, it's working great again." And so maybe they need to do that. On the other hand, we got no problems with their index of coincident economic indicators. It's working like a charm. We don't really have a problem with numbers that support our story. Any numbers that don't support our story, there's something bad with the data, or it's going to be revised. And by the way, that turned out to work for us with real GDP and real GDI. You know that story. We'll look at it in a second. But again, the stock market all-time record high, coincident indicators all-time record high, and that's very much almost a monthly indicator of the direction of real GDP. A indicator that's worked for us much better as a coincident leading economic indicator has been the forward earnings, S&P 500, and it's available both monthly and weekly. And so to the extent that it's available weekly, it's a leading indicator because there aren't too many data series that relate to the economy that are available weekly, maybe initial claims, but this is another one of them we find very useful. And look how well it correlates with the coincident economic indicators, which is available monthly, but with a lag, whereas the latest weekly number we have is for October 10th. And you can see that's at an all-time record high. So, Eric and I have made the amazing observation that when companies are profitable companies hire people and expand capacity, and unprofitable companies fire people and cut back on spending plans. And so here we've got analysts telling us that earnings are doing extremely well. And so that's one of the reasons why we think are optimistic on the economy. We think profits, we're kind of old fashioned. We think profits matter, and profits in many ways drive business decisions. So we showed our charts, which are in our earnings product. We got one of the chart books we have is updating our PE times E analysis, and we've been very consistent for a long time. We haven't changed these numbers. We haven't had to change the numbers. We're happy to say. So 250 earnings per share this year, 275 next year, 300 next year, and all the way by the end of the decade, 400 is where we think earnings are going to be. And this is on a ratio scale. These are our numbers for for the current year, the next 2 years. They certainly look plausible, consistent with the trend we've had in the past for operating earnings per share. And then we're monitoring every week where the analysts' heads are at. Do they agree with us or not? Kind of benchmarking the consensus to our view of things. And again, we really think analysts do a pretty good job of anticipating where earnings are going to go, as long as there's no recession in the forecast, because they don't see recessions coming. But that's what we do for a living, is try to anticipate them. So the bull market, a lot of the naysayers of the bull market say there's no way that the bear market could end with a forward PE of 15.3. That's not low enough. And we said, well, if there's no recession and the economy is proving its resilience, why not? And so we became increasingly bullish, and the PE has gone up to almost 22. I guess we'll be there within the next few days, the way things are going. And that's still well below, not well below, but it's below this. But this was a real bubble situation. And so we're kind of thinking, as Eric mentioned, we did raise our probability of a melt up from 20% to 30% when the Fed went big on the 50 basis point cut in the Fed funds rate. So far, it's kind of a garden variety bull market, up 62.6% since the beginning. Here's the comparable bull markets in the past. Some have outperformed, but this one's doing just fine, kind of par for the course. The operating earnings per share, when we do PE times Z, we actually project not only actual earnings, but where we think earnings expectations of the analysts will be by the end of the year. The market isn't discounting our numbers; they're discounting what the analysts are thinking. And so the analysts, we think that, in other words, we're forecasting the forecast. What are our analysts going to be saying at the end of this year, end of next year, the end of the following year? Will earnings be for the coming year? So we basically take our numbers and kind of use them as the projection numbers: 275, 300, 325. So we kind of project that the analysts are going to be in sync with us. And so these are our forward earnings numbers. And again, you look at the trend ratio scale, certainly looks like it's plausible. So they take these forward earnings numbers, 275, 300, 325 is year end this year, next year, and the following year, and then multiply them by a multiple of 21. And I have to tell you, we started talking about a range of 16 to 21 as sort of the plausible range for this bull market. And obviously leading towards the 21. So we took the 21, which looked kind of delusional not too long ago when we were talking about it. But now 21, everybody's coming up with explanations of why that makes sense and why it could stay up there. But 21 is about as bullish as we want to get on the PE. Anything higher than that is our melt-up scenario. And so take the 21, multiply it by those forward PEs, and you get something like 5,800 by the end of this year. So we aren't changing that. Even though we're above it, we're just saying it may just be, may require us to raise our melt-ups probability rather than our actual year end, because melt-ups, who knows? It's hard to predict exactly how high and where the top will be. We'll do our best to do that. Then 6,300 and then 6,800. So these are actually looking increasingly conservative relative to the market. And Eric and I both have hoof marks on our backs from the bull market, the bulls stampeding over us. So we've been among the most bullish, and not bullish enough, as it turns out. Operating profit margin, again, we're bullish. We got earnings to get our earnings. We got the profit margin going to an all-time record high in the next couple of years. I won't get into this. We've already talked about the real GDP was revised up. Real GDI was revised up. Instead of real GDP being revised down, real GDI was revised up. Everything looks just fine for the economy. It's a story we've told before. The statistical discrepancy was up here, and the pessimists were saying, "Oh my God, GDP is overstated. GDI is really where the truth lies." And it turns out that there was more personal income than was estimated. Eric, I think I covered the charts. Anything you want to add to that, or can we go to the Q&A?
Yeah, let's jump in. We can probably splice these two together. So the first one is Ed, what is your opinion on the steady decline in Chinese holdings of treasuries over the past few years? And we can probably talk more broadly about China
Yeah,
uh,
well,
and
yeah,
what's going on there.
that's for you, Eric. You're the master of where the Chinese hide their cookies in terms of the treasury notes and bonds. The actual data looks like they've cut down by about what quite a few hundred billions, right?
Yeah, maybe like a quarter or a third. But yeah, no, don't worry about it. China mostly puts their treasuries through other custodians in Belgium, potentially Luxembourg or the UK. And then a lot of Chinese banks under direction of the state will go buy or get dollar exposure in the swap market so they can depress the offshore yuan and boost their export sector. So don't worry about it.
I mean, there is evidence they're buying gold, right? I mean, after
Yeah.
The U.S. has a few times demonstrated that they're willing to freeze assets of countries like Russia, and so you have to believe that if they seriously intend at some point to take over Taiwan, they don't want to have their reserves frozen. They're going to keep some of them in Belgian chocolates. I mean, Belgian gold in the
Yeah,
vaults.
they've been raising their gold holdings, I think from 5 to 10 or 15% of their overall reserves. But the bid for gold, like Ed said, is more of a geopolitical concern. And it's not clear that they're actually selling treasuries to get gold. I think by and large, a lot of more central banks are shifting to gold, mostly like Iran, China, like quote unquote pariah states are ones who are at risk of being deemed so. Um, but like mostly the shift away from dollars has been like we'll take some krona or we'll get some Canadian dollars or Australian dollars. There's no real competitor there that's taking a meaningful share. I think the dollar is still 60% of international reserves. So
I don't know about you, Eric, but I was really very excited about the weekend, looking to see what the Chinese government would do on fiscal side to stimulate their economy. And there was a press conference on Saturday, and there was a lot of hoopla that, after providing all the stimulus on the monetary and credit side, they're now would shoot off the other bazooka, the fiscal bazooka, and it fizzled, right?
yeah, I think the Chinese government waited until the Fed, or at least saw the Fed's 50 basis point cut as their opening, to start stimulating without like, meaningfully risking capital flight, or the yuan getting too weak. But it's pretty clear that at least as U.S. rate expectations kind of pivot, the Chinese government doesn't really know what to do, and this whole like deleveraging situation they're dealing with is probably more akin to the great financial crisis here. And their measures to kind of increase consumption and reduce savings seem driven by the stock market and like a stock market craze in China. So I don't know. They're not really good at state directed fiscal stimulus, which is kind of funny.
Yeah, well, it is, and I'm kind of surprised they haven't so far, though they may change. There's your puppy over there, right?
Yeah.
Yeah. Well, our puppies like to show off to be on TV here. But why don't they do helicopter money? I mean, that's what we did during the pandemic. Three checks and give people money even if you widen your deficit. I mean, have they become fiscal conservatives? They don't want to widen their deficit. I can't quite fathom it.
Yeah, that seems like the big thing that everyone's waiting for. I'm not sure why they're not doing it. Again,
Yeah.
like boosting liquidity to get more stocks to like somehow increase household net wealth after the property bubble collapsed. It's way too indirect and just like
Yeah.
it'll operate with a huge lag if it even works.
Yeah,
So
I don't know. I don't know of too many successful attempts by governments that when a speculative bubble bursts, you try to get the air back at that burst bubble. I mean, isn't that what they're kind of trying to do? They're trying to get property prices back up, and they're trying to get stock prices back up, so the negative wealth effect is not so negative, and then people consume it. It's just like that's not going to work. So we'll see. Maybe they'll surprise us. Anything else, Eric, on the board here?
I think we have the view for the 10-year yield in the near term, and then presidential candidates' influence on the market's future estimates.
Um, the question is about where the 10-year goes.
Yeah.
Well, we've been talking about 4.25%. We think that's kind of back to normal bond yields, and so we're pretty comfortable. I mean, it was like late summer. We said get ready to short bonds, so that's actually worked out pretty nicely for us. And you had to know, of course, to do that the day that they cut the 50 basis points because the bond market went the other way. But we weren't surprised by the bond market going the other way, as you know, given everything we've told you so far. So 4.25%, I don't really have a problem with that. I guess if it gets to 4.25%, we'll have to start wondering whether it's 4.25 to 4.5%. But the elections obviously will matter. If it's a sweep, the outlook for the deficit and inflationary fiscal policy will worsen, and so that could be an issue for the bond market. I mean, the bond vigilantes have been all that vigilant over the years. They were for a while there in the 80s, and they seem to have come back last summer. But they kind of seem to be waking up a little bit here. So we'll see how they respond to the developments that we're seeing. I think Michael Brush had a question on outlook for gold, and if China keeps buying gold, gold isn't going to go down. I mean, and if the geopolitical environment continues, you get more partisan with democracies versus autocracies. The autocrats are going to certainly have a demand for gold. So gold. We have been pounding the table on gold because we're not good at gold in the sense that we like to have assets that have earnings or dividends or coupons, but we have been favorable to gold for a while. Eric, anything else on your end?
No, I think
Okay,
that's good.
good. All right, everybody. Thank you for joining us. Have a good week, and we'll see you again next week. Thanks,
Thanks,
Eric.
everyone.